So I want to start with this. Yesterday, we saw Alphabet and Apple really move the markets higher. But the rest of the tech complex, it kind of moved lower. Today, we're seeing a bit of a bounce back. What do you think that says about investor sentiment when it comes to big tech and maybe even the broader market?
Yeah, great question there. The broader market, we're in September, right? As everybody's been talking about, it can be potentially choppy after a 30% rally. We think it makes sense. It's kind of that dispersion. I mean, look at the market. Yes, tech is, I know it did okay yesterday. It started to lag a little bit. What's been leading? Energy, material, some of the stuff that's really, really small that honestly doesn't move the needle all that much because tech is so large. But I think that's a healthy market, kind of that baton getting passed around. Overall, we are still slightly overweight technology here. But if you talk about what's one of my one of my near-term worries, Frank, we are seeing a little bit of relative strength weakness out of technology. And like you said, it's kind of bifurcated, I guess, with some of the leadership. But big picture, to put a bow on this, we still do like large caps over small caps. And I know that's kind of been an interesting discussion the last 5 weeks or so. But the reality is, again, we like large over small. We think large cap tech still will do pretty well here going forward.
Just to your point about the energy space being smaller, our friends on Fast Money, they were saying last night that NVIDIA is twice the size of the entire energy sector when you're looking at market caps. So just give you a sense of where energy is these days. I'm going to go to some of your research. So we're worried about some seasonality, specifically with September. On average, over the last decade, S&P pulls back about 2% in September. So seasonality is a thing. But you gave us some other stats that I think are pretty interesting. So you say after the S&P's been up over 25% over 100 days, the average return after 1 month, that's 1%. The average return over 3 months is just about 6%. Does that mean, because we've certainly been up over 25% over the last 100 days, does that mean that you see the market rallying all the way into the new year?
We do. And, Tuesday was 100 trading days off of the April 8th lows, so the lows of, the near bear market. And near term, sure, that's extended. But again, 3 months later, like you just mentioned, higher 11 out of 11 times. So never lower 3 months later is what I'm getting at. So any seasonal weakness, maybe some strength. And a year later, up like 13% on average. This is just one stat, one statistic. But Frank, I've come on with you for a while saying the strength we've seen off those lows is not consistent with the bear market. We know we're not in a bear market now, but it likely does say we're still higher. We've got advanced decline line strong. And you talked about bonds. I want to touch briefly on this. Obviously, the 30-year yield is up around 5%, highest in a long time. All over Europe, long-term yields are breaking out. We do have a steepening yield curve, though, again, as the 2-year yields aren't nearly as high. But the reality is, what are the credit markets saying, right? I'm an old school John Murphy disciple, message of the markets. Credit markets still are showing virtually no signs of stress, no worry. So to me, if the bond market is going to spiral out of control, we'd see some warnings in high yield, junk bonds, credit spreads broadening out. We're not seeing it, Frank.
Right. I got to be honest, we're going to do bonds a little bit later in the show. We want to stick with equities with you while we have you very quickly. So I want to talk to you about what's coming up tomorrow, the jobs report. What are your expectations? How do you see it impacting the market? I was talking to a number of chief investment strategists and chief equity officers yesterday. They said that, the estimate's 75,000. They say if it's above or below 10,000, of that number, they see a market move. If not, they don't see it having a big impact. Agree or disagree?
No, I agree there. We think kind of the worst of the economy was again, a couple months ago, right when all the uncertainty over tariffs were there. Might come in a little bit higher than expected. It's going to be real interesting. Let's say it comes in much better than expected. I mean, who knows, but it could. I wouldn't be shocked by that. That might upset the apple cart a little bit, get that September volatility kind of pushing back on a Fed cut. We still think the Fed's going to cut in a couple of weeks, but maybe you're supposed to cut 6 times the next 16 months. Or maybe you don't quite cut that many times. Again, as the economy does a little better is kind of how we see things playing out.